Afternoon. I'm Patty Hasson. I'm the president of Clarifi, and I'm also a board member here at the Philadelphia Federal Reserve. I'm excited to be here today to moderate this timely panel. I thank the conference organizers and Jalapa in particular for inviting me to participate with this impressive group of panelists. Clarifi is the largest nonprofit financial health organization in this region. We provide one-on-one counseling and group financial education to help people save for the first time, improve credit, or develop a plan to pay back existing debt. Our counselors often want to be small business owners who are looking to improve their personal financial profile to start or grow a business, along with those small business owners who've used credit cards or home equity and are now looking to get that personal debt back out into the business or actually improve their credit. So we could have helped Max 25 years ago when he defaulted on his credit card to improve his credit score by getting that out of default, paying it back, and he would have gotten a 1.99 interest rate from the card company had he come to us then. So that's really our interest, I guess my interest in this panel. We see a lot of people who are using personal credit. There weren't a lot of options back in, banks aren't traditionally for very small loans. People tend to use their credit cards instead. So according to the Federal Reserve Bank's Small Business Credit Survey, 32% of small business owners that applied for credit in 2018 did so from an online lender. That's up from 19% in 2016 and 24% in 2017. So we have a panel today of 4 of those firms that are driving that growth, along with a founder of a business that streamlines underwriting and analytics for community banks. So given the tight time, I've asked each to kind of give you some visuals about what their business is about, talk a little bit about how they're expanding credit, and 1 to 2 regulatory challenges. I'll then follow up with a couple questions, and I'll leave room for all of you to ask your questions. So with that, I'll get started, and Ryan, bring it up.
Just click on my name. Yep. Great. Slide advances. Great. Oh, just, okay. Perfect. Thank you. So good afternoon. My name is Ryan Rosett. I'm co-founder and CEO of Credibly. So we're a profitable data science-driven fintech lending platform which improves the speed, access, cost, and experience to small and medium-sized businesses. To date, we've originated over $1 billion to small businesses of over 25,000 transactions. We have a diversified funding option. The majority, approximately 95% of what we originate, sits on our balance sheet. We also leverage syndication. Syndication oftentimes is used to mitigate risk. And then we have off-balance sheet for transactions that are lower yielding, higher credit-worthy, more near-prime customers that we have forward flow whole loan purchasers. Economic impact, Credibly provides working capital for any need or credit profile. We do have, which I'll get into in a moment, a proprietary scoring model. The last panelist mentioned, the black box. We're looking at just predictive data. There's a number of data points that we look at, but we're always looking for what can drive, either more lift in our approvals, and that's exactly what we're always looking for, is more yeses, less nos. So we have 4 product types as well. A more near-prime product, which is a BXL. It's an 18 to 24 month term, 10,000 to 250,000. It's quoted at 10% APR, maximum 36%. The majority of what we originate is a working capital loan. It's 6 to 18 months in term, $500,000 to $400,000 sizing, and 36% plus. It's offered as a daily and a weekly product, and then we have a merchant cash advance, which is a variable product that we're buying future receivables at a discount. And the MXP is a shorter term, more subprime product. So again, the using data science, and we have a robust data science team that accesses a number of data points. We acquired a portfolio of a $250 million portfolio that dated back to 2005. That has all the recession data in it, so we feel like our models incorporate by industry data that is really predictive in terms of going through 2007 to 2009. So in that included in our data, we feel is really a robust piece of our business. 75% of, or less than 75% of outstanding SMB loans are $250,000. So if you look at historically where banks sort of stop lending, that's where we sort of come in. So banks are not, I would say going back further, maybe a few decades ago, they were more interested on the C&I basis of lending sub $250,000. There's been a precipitous drop where they just aren't interested. The economics aren't there for them. So we're servicing a segment of a small business that really only qualify for that amount of money. There's comprehensive product coverage just on loans and MCAs. The smallest loan we'll do is $2,500. Again, we go up to $400,000. We offer SBAs. We offer equipment financing. This is all part of what comes through the funnel so that we can monetize it and find a place for it in the event that we're not an equipment leaser, but we'll find a home for it so that we can service the customer to find the best place for that customer. Again, the whole loan sales, we did our inaugural securitization, which was unique. Our product we have 1 year of product, 1 year of term, which is our average. So when you think about a securitization, we have a 3-year revolver, but it's unique that they're actually securitizing. The securitization market is open to this type of product. And it might just speak to the thirst for yield today, but there is a market out there that securitization is actually working. So the speed and approval, and this is basically the Fintech part of what we do. We're seconds to pre-qualify, less than 4 hours from approval and same-day funding. That is what we do. And so with that, we are risk-based pricing. We're looking at a profitability model. We're looking at a proprietary scoring model. And we also look at the industry type and what the affordability index is of a certain industry type. So for example, a grocery store has lower yield, so we'll look at their gross deposits and we'll provide a certain percentage that we believe they can afford from a cash flow standpoint and what they can afford to pay us. Diversification, we're geographically diverse just across pretty much all states as based on population. For example, I think California, we're at 16%. I think the population's 18%. But it goes pretty hand in hand with the population of the states. So regulatory opportunity and risks. From a data protection and cybersecurity standpoint, just our CTO was the former CTO for the FBI. He ran the national fingerprint, the national rifle licensing, which is a lot of underwriting process because they have 3 days, the FBI, to respond when a gun is issued to take it back. So he's working very fast. So it's, while it doesn't seem akin to small business underwriting, there's a lot of similarities. The consumer protection laws, the FTC appears increasingly interested in treating small businesses as consumers. They seem to be focused mostly on the advertising as well as the APRs associated with the variable product. Marketing disclosures, we have a full compliance team that looks at all marketing pieces that go out. Everything, from a deception standpoint, we are very clear to what we're offering a merchant. And there is a clear distinction in my opinion as to a merchant and a consumer. I know the FTC may differ, but that's what we think. Culture, compliance, we have over 100 years. I'm an attorney, my partner's an attorney, we have multiple attorneys working for us. Interestingly, for this crowd, we started out 8 months into starting the business in 2010. We did a joint venture with an FDIC bank. It was 80% owned by the bank, 20% owned by us. We had the FDIC in our office once a quarter. They were doing audits on all our files. We would originate, fund, service. We would sell the paper to the joint venture bank, and we took an inverse. So we took 80% of the profit participation off of that joint venture. It was subject to FASB rules, but it was an interesting structure. I think we probably, to the best of my knowledge, were the first joint venture with an FDIC bank. And then from a regulatory opportunity and risk, we have a full, comprehensive set of all policies and procedures for the life cycle, from the very beginning, from advertising all the way to the collection side of the business. We're fully integrated. We service everything that we originate. We work on the portfolio management side, which is the collection side, just to control the tone and make sure that our customers are treated the way we want them to be treated. Legislating in cases, we're always following the latest and greatest from New York to New Jersey to California, which seem to be the three most vocal states. Employee training, we do once a quarter, 100% participation, 100% passage rate. We have external audits. We have compliant management system. We do OFAC. We do all the testing that would be required. We're almost an extension of a bank, the way that we underwrite our files and the way we act. There's news monitoring, obviously, and then the marketing review. Everything that goes out has to go through our legal compliance team. So, I mean, that is who Credibly is. I look forward to this panel discussion, and thanks for having me today.
Boom. Thank you, everybody. My name is Ryan Metcalf. I lead regulatory affairs for a company called Funding Circle. By raise of hands, how many of you have heard of Funding Circle? Oh, hold on, I gotta have evidence of this. This is gonna be good for when I justify asking for a larger budget next year. Great. So Funding Circle started back in 2010 in the UK, 2013 in the US, and has since become the largest marketplace lending platform for small businesses in all four jurisdictions, the US, UK, Netherlands, and Germany. We've lent over $10 billion globally, close to $3 billion in the US. As of yesterday, I checked. So this might be a little outdated. But we've originated 17,000 loans to 14,000 businesses using the marketplace lending or peer-to-peer or crowdfunding model, depending on which jurisdiction you're in. That model, which, like many of the things we've discussed in this conference, came out of the financial crisis in an attempt to try to get businesses funding that they weren't getting from banks. The bad news is that they're still not getting the funding from the banks. Only 0.7% of banks' balance sheets are to small business lenders, which is a problem. So in the UK, we pioneered this peer-to-peer model. It's a little different in that the FCA had created a crowdfunding regime specifically for our industry, in which we have almost 90,000 retail investors in the platform. So we connect investors who want to lend with small businesses directly who want to borrow. In the US, we've tried to shoehorn that same innovative crowdfunding model into our dual regulatory system, which is extremely complicated. And so in the US, we can only offer institutional and accredited investors the opportunity to invest in the platform because the securities registration that's required for our fractional note program is too expensive and onerous, which is why almost virtually nobody does it. But we are trying to change that. That is also part of my job. But we're having a huge economic impact. In the only 6 years that we've been lending in the US, just last year, we helped sustain or create 38,000 jobs, which is about $2.8 billion to the US economy. I'll skip the product stuff because you can look that up online yourself, but we offer one product, which is a term loan from 6 months to 5 years, anywhere from $25,000 to $500,000, and the like. What I do want to talk about is the narrative that fintech is competing directly with banks is true. However, I think it's not necessarily as true. We're not necessarily adversaries with community banks. Community banks still play a crucial part in small business lending in this country. I believe over 50% of small business loans still go or originated by community banks. One of the things that we've done at Funding Circle is we're starting to partner with community banks. Intrust Bank out of Wichita, Kansas is one of our partners who buys whole loan loans from us. We have a referral relationship where the loans that come through their branches that they cannot originate profitably, they will refer to us, we will originate, and then give them the option to buy that loan back. And so that's a reciprocal relationship. Then the third option for a community bank is they can invest directly in the platform the same way a credit investor does, which is you buy a fractional interest in a loan, which is a passive slice of the entire portfolio, if you wish to spread your risk out versus having it in a one whole loan or in one geography. Could be a really great option for that. The other good thing is that almost 40% of our loans are going to businesses in LMI, low moderate income tracks, which is incredible and would be really great when CRA reform comes around, that our investors in the platform could get credit for those loans. They cannot today because online lenders, the way the CRA works. So that is the goal of CRA reform, is to make sure that there is some kind of credit being given for that work. The other is that we're bringing people to the investment side of the small business lending where it's not happening from the banks. We have more small business loans outstanding than 96% of FDIC insured banks. And then the reason why people come to Funding Circle is for two reasons: speed and approvals. It takes about 10 minutes to apply, whereas with a bank application, our last survey was about 8 hours just to fill out the application. We can turn around an approval in under 24 hours and fund within a day, whereas a bank, the last survey that we did was anywhere from a couple weeks to over a month to 2 months just to get a response on whether you were approved or not. So if you are a small business, your most precious asset is your time. And so that is why people are coming to us. 16% of people who come to Funding Circle tell us they could not get a loan anywhere else. I should caveat on the equal credit opportunities. It should say online lending helps eliminate prohibited biases. What I was referencing when I wrote that was thinking about recent studies that came out about the bias that exists in branch lending, where people walk in, and there are plenty of studies out there to show that bias is still happening for folks walking into branch. That is not the case for small business lending, luckily. But then we have the whole debate about machine learning and the like. I do want to talk about regulatory opportunity and risk. The Federal Reserve actually put out a report last week, I think it was 2 weeks ago now, talking about small business access and credit. And the two things that came out of that, and I want to talk about those two facts. Small businesses are responsible for 47.5% of U.S. employment, but the lending, as I said, is only 0.7%. Small business loans that are $100,000 nationally in 2015 remained 58% lower than pre-financial crisis. We are just now getting to par today on those levels. And as a result, 32%, which was mentioned earlier by Patty, of small businesses are going to online lenders, which is up from 19% 2 years prior. The Fed, there was two things that came up on the Fed study, that approval rates are higher at online lenders than traditional lenders. 82% at online lenders versus 71% at small banks and 58% at large banks. However, the problem is satisfaction levels with online lenders are far lower. Net satisfaction of 33% at online lenders versus 73% at small banks and 55% at large banks. And the reason is because there's information asymmetry in the market, which means customers that are going online to get a small business loan do not understand the difference between one product in one company and another, and they cannot comparatively shop. And so they are confused by the terms and conditions in which they are being offered. A few years ago, we recognized this. A funding circle, opportunity fund, lending club kind of helped start what's called the Responsible Business Lending Coalition, the RBLC, to kind of create a framework in which we can self-govern the industry to create a high bar of standards, including disclosure, which includes the use of APR as the standard metric across all small business products, including merchant cash advance or estimated APR, among 6 other different principles. To address this problem, we then realized that that was great that all the good guys in the room were doing the right thing and helping consumers, but there were still plenty of lenders out there that were not. And so about a year ago, we passed SB 1235 in California, the first in the nation Truth in Lending Disclosure Bill for small business lending, and we are working daily to try to pass that in other states. And the chairwoman of the Small Business Committee had announced her intent to introduce a bipartisan federal bill to do the same. One other thing I want to jump into, so that's along the consumer protection, and there's a whole host of other things there's a problem in the market. There's an issue with brokers. Many of the brokers that were run out of the subprime mortgage space, thankfully due to regulation because they were licensed and brought in, thanks to people like Mr. Neiman, they have now changed their signs over to doing small business brokering, and the problem is there's perverse incentives in which brokers drive small businesses into loans based on the percentage that they're going to get, not because the loan is the best for that borrower. And so there's some issues of duties of care. The thing that I'm most concerned about right now, and there's a lack of research about this, and we are in the right room of people who are looking for research to do, is around usury. Quite recently, and there's been an effort to move usury caps on the consumer side, primarily around 36%, which has passed in California. There's now been bills introduced in the federal level to do the same. The line between consumer and business is getting very blurry, primarily because small businesses, the majority of them, like 90-something% of them, have employees under 20. And many of them are sole proprietors, and so they need the consumer protections. Where it gets sticky is the conversation is now starting to be drawn under lowering usury caps or creating usury caps for small business lending, and there are a few, one by the Aspen Institute, that I saw talking about why small business loans have to be priced the way they are. And what does not exist in the market is something to talk about the impact of lowering usury and what that does to access of credit. So there's 2 bills I'm specifically thinking of. There's a bill in New York to lower the usury cap for New York from 25 to 16%. There's one in Rhode Island to lower it from 21 to 12. And I've had legislators tell me that it will not affect the access to capital. The market will just reprice itself. So whatever studies come out, I would love them. I have quite the thing. I'll just wrap by saying there's an opportunity around what government can do to help. In the UK, it's very different. The European Investment Bank, the UIB, and the British Bank both invest in the Funding Circle platform as investors to help spur economic growth. In the US, we don't have a function like that. We have reverted to 2 kind of systems. One is the SBA, which is a loan loss program, and we have, or a loan guarantee, and then we have state programs, which are loan loss programs, and really only 2 states have those. Other than that, I can't think of any other government opportunity to help small businesses where the banks are not, particularly under the $100,000 mark. CDFIs are probably the closest, and that fund, I think the last study I saw was they approved $3.5 billion in loans last year, and there was $14.5 billion requested, or something similar. And so there's obviously a larger demand than what's being provided by the government. Non-bank lenders, who are doing the majority of lending to the businesses, are not allowed to participate in any of these government programs, even though we are licensed, Funding Circle, by state regulators. And so I'll just leave you with that, because there are plenty of opportunities, but to say that there's lots of room for, the regulatory can help in many of these instances, particularly in consumer protection, which we were talking about earlier, but it can also get out of the way from holding us back. Thanks.
Great, thank you. Just very briefly, Opportunity Fund is different than some of the other organizations up here. We're actually a nonprofit community development financial institution. We've been around about 25 years, but what I think is really germane to this conversation is that our mission really has evolved. Originally, it was to serve small businesses that couldn't access credit from financial institutions. Today, that need has grown as traditional banks have pulled out of the market, but our mission has also evolved to make sure that the access they have is affordable and responsible. So in some ways, there are more yeses happening today, but whether or not all the access to capital that is being provided is actually helping the small businesses is increasingly a question. We were founded in California, but we're now lending online in 45 states through a partnership I'll talk about briefly. So we serve three primary customer segments. Our micro customers, which are typically sole proprietors, very small businesses, typically very small loans, sometimes overlap with the consumer space. So both our micro customers as well as our trucking customers, we also serve independent owner operators. Those are customers that traditionally have not been served by financial institutions and still aren't being served there, although they are increasingly turning to online options. More of your traditional kind of Main Street businesses are who we serve through our online offering, which is in partnership with Lending Club. We've been partnering with them for about 4 years and recently expanded this year, where they source the loans, and then those that they weren't able to finance, they turn over to Opportunity Fund. And those are really the businesses who used to get financing from banks and can't anymore. And as previous data has suggested, more and more businesses every day are turning online to access credit. Some other data here, I won't go through all of it, but one I did want to share is we partnered with the Financial Health Network, formerly CFSI, to do a study looking at our three main customer segments and comparing if they got a loan from Opportunity Fund or from the most likely alternative providers for their segment, how much money would they pay, not just up front, but given their cash flow, what was the likelihood that the overall cost of the loan, what would be the variance? And what we found was, at the low end, it was $5,000 savings from Opportunity Fund, and at the upper end, it was $23,000. And the reason I wanted to share this is twofold. One, there are very high cost products out there, and I think that's very important to note. Our other research has found an average for many of the alternatives of 94% APR. Also, I think when you see this number, what it indicates is that there's a tremendous opportunity, that there are credit-worthy customers who are not being served either by traditional financial institutions or really by many of the fintech alternatives, at least at a price point that they can afford. As far as policy recommendations, I certainly have many. I'll just highlight two here. One is that we really need a strong, robust, modernized CRA that includes both the fintech lending and a lot of the non-brick-and-mortar lending that is happening, but need to be very thoughtful about that, and we certainly would like to see the federal regulators working together on that. And the other I'll mention, it's also very timely, is data collection. You may think it's unusual to list additional regulatory burden as something that would support innovation. However, we believe that having full insight into the breadth of the small business lending market, the types of providers such as the innovators here today, as well as a variety of different types of providers, about who is lending, who they are lending to, the extent to which underserved groups, including women and minority entrepreneurs, are or are not being served, and the prices that they are paying is incredibly important, and the minor costs associated with that will be more than overcome with the new opportunities that it provides to really fill that gap where there are creditworthy borrowers that aren't being properly served today. Thank you.
Hi, everyone. I'm David Snitkof, Head of Analytics at Cabbage. How many of you heard of Cabbage? All right. I won't take a picture. But so Cabbage, just to give a brief introduction, is a technology company that helps small businesses grow and manage their cash flow by providing access to capital and fast access to capital. So we've provided over $8 billion in loans to small businesses all around the United States. We've done that by making over 1 million, well over 1 million actual loans. So these tend to be fairly small, fairly short-term loans to businesses that are true small businesses. 80% of our businesses that are our customers have less than $250,000 in revenue. Most of them have fewer than 10 employees. These are really Main Street small businesses. And we're able to provide financing to these businesses by having persistent access to customer permission data. That means that we don't just underwrite based on traditional data such as credit bureau data, although we like that because it provides additional signal, but we let a small business connect many different data channels so that we have real-time access, fully permissioned by the customer, into the financial cash. So we're able to do that because we have this persistent access to data, and we can actually model the cash flow of a business, understand their inflows, understand their outflows, and because we maintain that access to data, we're able to offer a line of credit product that grows and adapts both in terms of line and price and duration as that business's needs change over time. So the average Cabbage borrower takes about 17 loans over the lifetime of their relationship with Cabbage. It's not a one-time loan that you just pay back. You can take a loan and pay it back and take a loan and pay it back, all off of one initial qualification decision. So I had some slides about economic impact. The numbers are very good. What I'll just leave you with, and I'm sure we'll talk about this in the questions, is that cash flow-based underwriting has the ability to really expand access to credit, especially when you're able to use non-traditional data that typically has not been used by the banking sector in addressing small businesses. There's a great study done by FinReg Lab that actually quantified the impact in terms of availability of credit, access to credit from cash flow-based underwriting. We were a participant in that study, both through our policy involvement as well as actually providing data to them to do that study. And so very excited to talk to everyone today about small business lending, policy around small business lending, and particularly around, in-person versus online small business lending. And my personal thesis that I'm very passionate about is the ability for online data-driven financial services to actually increase the humanity and personalization, particularly in offering financial services to small businesses. Thank you.
Hi, my name is James Wu. I am the founder and CEO of MonJa. We are a bit of a different firm. So I'm one of the co-founders of the companies, and we help lenders and banks, particularly community banks, in underwriting. So today we have helped funded over $1.5 billion of loans. Instead of talking more about our product, I want to jump in about the opportunities for improving credit access, because there are more than one ways of doing it. I think a couple of firms have spoken about doing direct funding and with Fintech being the funding vehicle to expand access. That's certainly one way. But at the end of the day, these days I speak to a lot of community bankers, and one of the observations that are still coming up is, there's a lot of anxiety about fintechs coming in, and at the same time, there's constant reminder that a lot of business funding, particularly small business funding, is still going through community banks. So one of the opportunities that we've identified, and we know there are others in this space, is how do we help community banks accelerate funding while still keeping them in the driver's seat? So some of the things that we know really can help are enabling technologies that help community bankers do underwriting, so such as instead of simply rerouting their leads over to fintechs for funding, if community banks have technology and process that allows them to quickly process loans and applications electronically and utilizing the latest technologies, they have the ability to make a much bigger impact. So in addition to looking at the cash flows and so on, some of the technologies could include machine vision and automatic recognition of documents. These are things that community bankers do, and they're extremely manual, but are necessary for some of the loans that don't quite fit the fintech funding box. So using technology to assist in accelerating this type of underwriting, freeing up community bankers to actually do the analysis and understand the industry and understand the particular credit is pretty important in our view. And fintech has a role here. Now, since we don't have a horse in the race with the regulation, I do want to bring up some of the more, I would say, controversial use of technology and big data and AI that we've seen. Some of the firms that we work with are somewhat more away from the limelight compared to a lot of the folks that are in the panel today and throughout the conference. So some of the examples of underwriting using big data we've seen is, on the left, you see one example where actually each individual red dot is a cell phone device. And through anonymous tracking, you can actually get pinpoint individual locations of devices. You know where they. So for each individual, you don't get their names, but you know where they live, you know where they work, you know where their kids go to school, and that paints a pretty comprehensive picture. It's a scary prospect, but technologies like these can help provide credit access. So instead of pushing for a particular regulatory action, I just ask regulators to keep an open mind and observe the space and see if this is an opportunity or a threat. So with all that, I look forward to the conversation of the panel in talking about both access to capital as well as regulatory challenges. Thank you.
Thank you, panelists. And now that I'm frightened, I'm going to turn my cell phone off because I don't need to be tracked any more than I am. I'm going to start with a question. Ryan, you brought up the topic of California passed legislation. I understand New York and New Jersey are thinking about enacting TILA-like disclosures on small business loans. How do you all feel that is for your business? How is it for the small business consumer? And any thoughts around this state-by-state enactment and how that also will impact your business?
Sure. So, anything that increases transparency is really good. So many financial products all throughout time, whether they were offered by banks or non-banks, have had, as Max talked about, the business model hidden in the fine print. And so anything that brings that out into the open and lets people make informed decisions about whatever financial products they choose is a very, very positive development. I do think there's an important thing in differentiating between a consumer use of credit and a business use of credit. And of course, with small businesses, you do blur the lines somewhat. Every small business is a consumer. You get to be a slightly larger small business. You think of yourself maybe less of a consumer and more as a pure business actor. The thing we see, though, when small businesses are applying for credit is typically they're thinking of making an investment. They have a purpose in mind. So they need funding either to bridge a working capital need or to buy a certain piece of equipment or to expand their staff or to open a new location. And so the levers that they think about using when they come to finance that sort of thing, sometimes they think about interest rates, and they should think about interest rates. The other thing they sometimes just think about is ROI. Can they make an investment? If they get that money, that allows them to invest that money in their business and make some sort of return on it, whether it's to manufacture a product or buy inventory or open a new restaurant or something like that. They couldn't do that without that money. And so I think if you're a regulator and you're thinking about disclosure and rate caps and things like that, you have to think about, for small businesses, they do think in terms of investment in ROI, not just purely in interest rates.
I think just to add to that, I think pricing is a really important signal, and I think it encourages business owners to stop and take a little bit more time. We know that business owners are strapped for time, and they're also strapped for cash. And ultimately, the last thing we know is that they're highly confident individuals, and they're confident in the ability of whatever investment they're making will help them out. But what we have found and what research suggests is really being able to compare these different products and compare them in a standard way enables them to slow down and think, hey, but what about my credit card? Or is this really going to be so good that I should take this opportunity? And the other thing we know is that a lot of times when business owners are taking out capital for something, it's not for something good that has happened, just like consumers, it's for something bad that they are trying to prevent happening. So when that piece of equipment has broken down, when they have a flood, when they have some other type of situation, when there's a natural disaster, these are issues where the ROI is more about staying afloat. And in those kinds of cases, it's also very important for the use of the capital to be paired with the pricing. So we think it's a great development. And just also to answer your last question, Patty, I think we would love to see this be standardized at the federal level, and are working very hard to make sure that different states are learning from each other and are hopefully being as harmonized as possible.
So I would add that, what happened in California, it seems as if it's a law. It hasn't yet gone through the regulatory process yet, so they're still working out the disclosure piece. New York and New Jersey, I think, are tracking California, but nothing that we can actually, in my opinion, comment on. In terms of reputable fintech small business lenders, I believe that they're ensuring that there's clear and concise terms to the small business owner. Otherwise you're going to have the likelihood of a potential default or a claim of deception, which is something that nobody wants. So the other, there's a risk-adjusted piece to what we do, and you can look at the landscape of fintech lenders, and specifically in the small business space, there are very few that make money. So while I think there's a perception that by putting caps at 16%, 24%, 36%, whatever it is, that's going to control it. If you study the actual market of what we do, there's very few. Most of them are losing money. So and you can say that they're charging these astronomical rates. How could they possibly lose money? The cost of acquisition for the customer, the loss rates, the cost of capital, the human capital, the tech investment. I mean, there's a whole bunch that goes into having a company and providing capital. I believe as a lender, we're making offers, risk adjusted, to a customer. We're not telling them to take it. We're making it very clear that here is an offer. If you have another option, please, if you can go to a bank and you want to wait 90 days, that's fine. But this is what we can offer if you have an opportunity to access capital today and seize an opportunity.
Thank you. Another question that has come up is the opportunities. I mean, the growth in online lending, 32%. What are banks, commercial banks, community banks, James, you might want to touch on, or credit unions missing in this space that you're drawing in?
Well, our view is community, and I think this will be echoed by many on the panel, is that community banks and fintechs are not either or. They work better in a partnership. There are multiple ways of going through the partnership, and I would emphasize there are many types of underwriting that are still very difficult for fintechs to underwrite through a score-based, standardized approach. A few weeks ago, I was talking to a banker who was evaluating a customer who has 300 hogs and 200 cattle as part of the collateral, and that's unless you do your scoring model based on that, you can't fundamentally put that as part of your variables and have a black box model. So we think collaboration really is the approach here.
Can you talk a little bit about your loan losses and what they look like, and in particular, or in addition, how borrowers that are in default, when I think of a community bank, I know they tend to try and work with that borrower to keep them in the community. What does it look like in your world?
Yeah, so running a small business is really, really, really hard. And I think if you don't run a small business or you're not involved in small businesses, sometimes you don't appreciate how close to the edge a lot of businesses are. Many business operators really operate very close to zero, and they're constantly trying to stay above zero. So if a business is having trouble paying, that is a very, very difficult situation. And so at least at Cabbage, we do our own servicing, we have in-house collections, we work very much with the customer to try to solve problems up front, find something that works for them. We want to get our money. Of course, everyone wants to get their money back, and you do take a loan, you have to pay it back. But we also, we'll do extend payment plans if it makes sense. We'll work with someone. We're not trying to put the squeeze on someone in an already difficult situation. I think that it ends up being a challenge, and the big criticism of the online lending industry is that people haven't been through a recession. Certain lenders have data that goes back further, of course. I think that what will be very interesting to see, and the jury's still out, is how many lenders will act if there is a negative turn in the credit cycle. And part of that is influenced by where people sit in the payment hierarchy, and then what people will do depending on where they find that they sit in the payment hierarchy. There are a lot of hypotheses as to saying, okay, I'm at this place in the payment hierarchy because our customers love us or something like that. You never really know. You try to build that brand and you try to build that customer affinity, but of course, if you're a small business owner, you're going to do what's right for you. So I think the jury's out on that kind of thing.
I'll just add, we also have an economic hardship program. So, in the case of, again, natural disasters, we've seen far too many in California recently, as well as other types of downturns. We are seeing a downturn in the trucking industry right now. So we do have an ongoing hardship program, keep servicing and collections in-house as well. And I think that it's important to, another way we try to work on it is really making sure that the underwriting at the outset really is taking into account both the household as well as the business financials, because ultimately what we see again with the very small businesses is these things are intertwined. So making sure that the ability to repay is there, and that the term of the loan is sufficient enough that even if there is a dip in cash flow, there's a bit of wiggle room.
David said it best, and I think Max before. Most fintech companies are certainly doing stress testing and back testing. We certainly are. Our investors who take on the risk of these loans are ultimately responsible for the losses, and they're certainly, we model this out. But again, we came out of the recession, so I think it's certainly fair to say that it's to be determined. What I will say is what we are focused on, which happens, or at least happened the last time, the reason Affirm, the company before who I worked for before this, the reason Affirm came about was Bill Me Later 2.0 is essentially what Affirm is. When the economy collapsed, Bill Me Later had a warehouse line, and that line got pulled, and they had to go and sell. And so that's how that whole story worked. And the way of trying to keep capital flowing is you try to diversify as many assets as you can, or as many warehouses as you can. The reason why I'm so passionate about the marketplace model and why it's worked so exceptionally well in the UK with 90,000 investors is we have more diversified lines to keep that capital going. In the US, you can borrow from Funding Circle, but you're limited to 360 investors, institutional and accredited. And if we can get the SEC and the government to work together to facilitate this program, we can get more investors to the table to support small businesses, which is primarily what I'm focused on.
Okay, thank you. I think what we're going to do now, because we're getting to the end, is audience.
I'm a professor at NYU. My name is Coach John. I have a question for Ryan, David, and James. It's all about data and doing research in this space. I think, Ryan, you mentioned this interaction between, for example, usury caps and access to lending. Do you have some data which can be made available where people can study this or other issues related?
I mean, Funding Circle certainly has its loan data. So the thing I tell legislators, now that these bills have come up, is we have a grading system. We have A through E. Primarily, we serve A through C. We have a very specific customer that we're able to serve with the marketplace model based on what investor is willing to demand, which is a target return, right, between 5 and 7%. With that said, fuck, I lost my train of thought. Sorry, I totally lost. Can you repeat the question again? Oh, the research on usury.
Yes.
Yeah, sorry. I can essentially do the math and say if you lower the usury from 25 to 16, we have our pricing models built out. We will have to eliminate B and C. We will only be able to serve the near prime users. And the rebuttal I get is, no, you'll just reprice. And I say, well, no, that's actually not how credit works. Your real issue is with risk-based pricing. And if you want to change that, then that's a whole nother discussion. But pricing will only ration credit and will only be able to serve one market. And you will return people to the black market to access credit from who knows who. And secondly, we have the bank partner model, which many lenders use today, that preempts state usury law. We choose not to do that. We have a state-by-state licensing system. There's 6 states today. There's 2 more proposed. And so you essentially force fintech lenders to consider the bank partner model, where they won't even have to worry about states. And so that's not what we're advocating for. But if these laws move forward and they lower the caps to unreasonably low rates, we'll have no choice.
David, you said there was a study.
I'm sorry, can you grab them after, because I'm getting the hook here. So I don't know, Bob, if you had a quick question, and you can grab them after to talk about.
So I just want to talk about collections for a minute. So I get all the interest in the legislation around confession of judgment, but I would challenge us to think a little better about could we do better than the Fair Debt Collection Practices Act? Because we're not exactly sure that's really serving the consumer. Why should we use that as a standard for small business loans?
I'll give one person the opportunity to answer it, and then we'll have to wrap up. Gwendy, go ahead.
I think if you have specific suggestions, now is a great time.
Okay.